Welcome to Aviation Intelligence Weekly with Sarah and Mike, your guide to the aviation industry. Welcome to Aviation Intelligence Weekly. I'm Sarah, and I'm here with Mike to break down JetBlue Airways' 10K filing for fiscal year 2025, filed February 12th, 2026. Mike, this filing tells a story of a carrier trying to execute a turnaround while facing some pretty significant headwinds.
That's right, Sarah. JetBlue reported a net loss of $602 million on revenue of $9.06 billion, which is actually an improvement from their $795 million loss in 2024. But the underlying dynamics reveal something more complex about where this airline is headed.
Let's get right to our narrative classification. How would you characterize what changed in this filing?
The narrative has hardened because management explicitly cited tariff uncertainty weakening consumer demand as a driver of their capacity reductions, and because they're warning that expenses will continue to increase from wage rate cost pressures as we acquire additional aircraft and as our fleet ages. This isn't just cyclical softness. They're describing structural cost pressures meeting demand uncertainty.
That's a concerning combination. The filing shows they reduced system available seat miles by 1.6% year over year and saw revenue passengers decline 2.9%. Management is essentially retreating from growth while costs keep climbing.
Exactly. And what makes this hardening particularly notable is that even with these proactive capacity cuts and lower fuel costs, fuel decreased $286 million or 12.2%. They're still posting significant operating losses. The operating loss was $368 million, which translates to a negative 4.1% operating margin. Akashi, material changes and pressure points.
Let's dig into the financial pressure points. What's the most significant shift in JetBlue's cost structure?
The dominant pressure point is cost structure durability under demand stress. Operationally, JetBlue is caught in a vice where unit costs, excluding fuel, increased 6.2% to 11.2 cents, while they're cutting capacity to match weakening demand. For investors, this means the airline's cost base isn't flexible enough to maintain margins when revenue softens.
The numbers really tell that story. Can you break down what's driving these cost increases?
Three specific areas are creating structural pressure. First, labor costs increased $190 million, or 5.8%, including a 9% pilot contract increase that took effect in August 2024. Second, maintenance costs surged $163 million, or 26%. That's primarily due to what management called timing and cost of Airbus 320 engine repairs. Third, they're dealing with fleet transition costs as they complete their Embraer E190 retirement through Q2 2026.
So, even as they're trying to simplify to an all-Airbus fleet, the transition itself is expensive. What about their revenue diversification efforts?
There's one bright spot. Other revenue increased $64 million, or 9.6%, primarily from higher TrueBlue loyalty program revenue. But this couldn't offset the $281 million decline in passenger revenue. The loyalty program growth suggests they're extracting more value from existing customers, but the core flying business is under pressure. Dwarkirsi management commentary signals.
Mike, let's talk about management's tone. What signals are coming through in their commentary?
Management's dominant signal is cautious realism about external constraints they can't control. In the MD&A section, they specifically stated that tariff uncertainty weakening consumer demand and reduced air travel spending drove their proactive capacity adjustments. This isn't typical airline cyclical language. They're pointing to policy uncertainty as a demand driver.
That's unusually specific for airline management commentary. What else are they telegraphing about the operating environment?
They're being remarkably direct about cost pressures. Management stated they expect our expenses to continue to increase from wage rate cost pressures as we acquire additional aircraft and as our fleet ages. Operationally, this suggests they see limited ability to bend the cost curve in the near term. For investors, it means margin recovery depends almost entirely on revenue growth, not cost management.
They also seem to be managing expectations about performance consistency. What did they say about that?
They included a notable disclaimer that results may not necessarily be meaningful. You should not rely on our results for any one year as an indication of our future performance. This suggests management expects continued volatility as they work through their jet-forward strategic framework and fleet transition. Akashuri risk disclosures.
Let's move to risk disclosures. Were there any new or escalated risks in this filing?
Risk disclosures were largely unchanged from the prior filing. However, the filing does emphasize ongoing Pratt & Whitney engine issues, with management expecting groundings to remain in the mid-single digits in 2026, though they believe peak groundings have passed.
So, the engine issues are a known quantity at this point, not an escalating risk?
Correct. Management seems to view the Pratt & Whitney situation as manageable within their fleet planning. Operationally, they're building these groundings into their capacity assumptions, rather than treating them as unexpected disruptions. For investors, this suggests the engine issues are already reflected in their guidance and shouldn't create additional negative surprises. Durant, liquidity and balance sheet stress.
How is JetBlue's balance sheet positioned to support their strategy through this challenging period?
The balance sheet is enabling rather than constraining their strategic execution, but with important caveats. JetBlue maintains $2.5 billion in unrestricted cash, equivalents, and securities, plus a $600 million credit line. They also repaid $461 million in debt and finance lease obligations during 2025.
That sounds reasonably strong. What are the caveats?
The caveat is the scale of their debt burden relative to profitability. They're carrying $8.47 billion in total debt while generating negative operating income of $368 million. Operationally, this debt service requirement creates a fixed cost base that limits their flexibility during demand downturns. For investors, the key question is whether their jet-forward strategy can generate sufficient cash flow improvement before liquidity becomes a constraint.
With cash burn at current levels, how much runway do they have?
The filing shows they have substantial liquidity, but at a net loss of $602 million, they're consuming cash to fund operations. The balance sheet gives them time to execute their turnaround, but it's not indefinite. Their ability to maintain this liquidity position depends on operational improvements materializing relatively quickly. Segment analysis.
JetBlue doesn't break out traditional segments, but let's look at what's driving versus dragging their performance.
The loyalty and ancillary revenue business is clearly the growth driver. The TrueBlue program and other revenue streams grew 9.6% to $730 million, showing JetBlue can extract more value from their customer base even as passenger counts decline. This suggests their brand and customer relationships remain strong despite operational challenges.
What about their core flying operations?
The core passenger business is under significant pressure. Revenue per passenger is declining as they compete for fewer travelers in a softer demand environment. Operationally, they're managing this by cutting capacity and focusing on their East Coast leisure network as part of JetForward. For investors, the question is whether this network focus can restore pricing power and load factor performance.
They're also planning to launch domestic first class in 2026. How does that fit into the revenue picture?
The domestic first class launch represents their bet on revenue premiumization. Management plans to complete the majority of their fleet with first class by end of 2027. This could help offset some of the pressure on economy class yields, but it also requires capital investment during a period when they're already managing significant cost pressures. What to monitor next?
Mike, as we look ahead to future filings, what should investors be watching to confirm or contradict this narrative?
Here are the 4 key items to monitor. First, watch unit revenue trends, excluding loyalty program growth, because it will confirm or contradict whether their network focus is restoring pricing power in core markets. Second, watch CASM ex-fuel progression relative to capacity changes, because it will confirm or contradict whether they can achieve cost flexibility as demand conditions evolve. Third, watch cash flow from operations turning positive, because it will confirm or contradict whether JetForward is generating the operational improvements needed to support their debt structure. Fourth, watch domestic first-class revenue contribution once launched, because it will confirm or contradict their strategy of premiumizing revenue streams to offset competitive pressure in economy class.
Those metrics will really tell the story of whether this turnaround is taking hold or if the pressures continue to mount.
Exactly. JetBlue is at an inflection point where external demand pressures are testing their ability to execute strategic changes. The next few quarters will be critical in determining whether they can stabilize the business or if further restructuring becomes necessary.
That wraps our analysis of JetBlue's 10K filing. Remember, this analysis is for informational purposes only and should not be considered investment advice. I'm Sarah with Mike, and we'll see you next week on Aviation Intelligence Weekly.
Thanks for listening, and keep watching those SEC filings.